Hello friends, we are going to talk about mutual fund. What is a mutual fund? A mutual fund is an investment vehicle made up of a pool of money collected from many investors for the purpose of investing in securities such as stock, bonds, money market instruments and other assets. Mutual funds are operated by professional money managers who allocate the fund's investment and attempt to produce capital gains and or income from the fund's investor. A mutual fund's portfolio is structured and maintained to match the investment objective stated in its prospectus. Mutual funds are of two types: open-ended fund and closed-ended fund. Close-ended fund. The close-ended fund open at particular period. A closed-end fund is organized as a publicly traded investment company by a Security and Exchange Commission, that is SEC. Like a mutual fund, a closed-end fund is a pooled investment fund with a manager overseeing the portfolio. It raises a fixed amount of capital through an initial public offering, that is IPO. The fund is then structured, listed, and traded like a stock on a stock exchange. Advantages of mutual fund: increase diversification. A mutual fund diversify holding many securities. This diversification decreases risk. Daily liquidity. Shareholders of open-end funds and unit invested trust may sell their holding back to the fund at regular interval at a price equal to the net asset value of the fund's holding. Most funds allow investors to redeem in this way at the close of every trading day. Professional investment management. Open and closed-end funds hire portfolio managers to supervise the fund's investment. Ability to participate in investment that may be available only to large investors. For example, individual investors often find it difficult to invest directly in foreign markets. Mutual fund has also some disadvantages. These are as follows. The mutual fund has some fees. In mutual funds, the investor has less control over timing of recognition of gains. In mutual fund, the investor has less predictable income. No opportunity to customize. SEBI, that is Securities Exchange Board of India. SEBI regulates these activities. SEBI allow broker to invest 10% company to lower down the risk of investor. The revised regulation embodied far-reaching charges in the regulation and function of mutual funds. The revised regulation provided for enhanced level of investor protection, empowerment of investor, strengthening disclosure norms in the offer document so that investors are better informed, better advised, better aware of risk and reward. Standardization of norms for valuation of assets, computation of net asset value of schemes of mutual funds, and accounting standard and policies. Now, we will talk about financial planning pyramid. The initial stage is health insurance, in which health issue provide the financial help to an insurer in case of any health problem. The next stage is life insurance, in which the company provide financial help to any family in case the family has lost any member. The next stage is emergency fund. This fund is created at the time at any time. This fund is used in case of any emergency. The next stage is equity market, in which the financial planner segregate the investment account in some ratio. Investment risk. Returns are not guaranteed. While stocks have historically performed well over the long term, there is no guarantee you will make money on a stock at any given point in time. Although a number of things can help you assess a stock, no one can predict exactly how a stock will perform in the future. There is no guaranteed price will go up, or that the company will pay dividend, or that a company will even stay in business. You may lose money. Stock prices can change often and for many reasons. You have to be comfortable with the risk that you might lose all of your money when you buy and sell stock, especially if you are not planning to invest for a long term. If you use leverage to invest in stock, like buying on marginal or short selling, you could lose more than you invest. There are many ways to manage risks. Some are as follow. First, hold a diversified stock portfolio. You may be able to reduce the ups and downs in the total value of stock portfolio by buying stock from companies with different features. Invest for the long term. The stock market is subject to short term fluctuation as well as bear markets. But over the long term, the stock market has historically performed well. If you buy stock with money that you may need soon, you may be forced to sell in a period when a stock price is down. If you buy high and sell low, you lose money. Don't try to time the market. Trying to time the market can be a risky strategy. You may hear about a stock that is climbing higher and higher in price. When more investors decide to jump in and buy the stock, the drive price is even more. The fourth is get advice if you are not a knowledgeable investor. It's always risky to invest when you don't understand how the stock market works, what makes a stock price rise or fall, or how an investor or investment strategy work. The more you know, the more you can lower this risk. If you don't feel comfortable with your level of knowledge, a qualified investor can help you choose stock and other investment that meet your goals and tolerance of risk. Be careful about buying private stock. Some companies keep their stock in private hand instead of trading their stock publicity on the stock market. Some companies keep their stock in private hand instead of trading their stock publicity on the stock market. The stock is owned by a group of shareholders who can only sell their stock with approval from other shareholders.